The volatility of cryptocurrencies isn't everything. In fact, several of them are expressly engineered to keep their value constant, stablecoins. In an economy where coins and tokens may fall overnight, there is a huge desire for currencies that combine the benefits of blockchain with the ability to track a more reliable commodity. If you haven't already begun utilizing stablecoins in your trading or investing, it's worth understanding more about them, as well as the benefits and disadvantages they provide. In cryptocurrency, what is a stablecoin? Stablecoins are digital assets that are linked to the value of fiat currencies or other assets. You may, for example, buy tokens tied to the dollar, euro, yen, and even gold and oil. A stablecoin enables the holder to lock in gains and losses while transferring value at a consistent price via peer-to-peer blockchain networks. Bitcoin, BTC, Ether, ETH, and other cryptocurrencies have always been volatile in the past. While this offers several chances for speculation, it does have certain limitations. The volatility of cryptocurrencies makes them difficult to employ for day-to-day payments. For example, a merchant may accept $5 in BTC for a coffee one day, but their BTC is worth 50% less the following. This makes it difficult to plan and run a company around. Previously, there was no method for crypto investors and traders to lock in a profit or prevent volatility without transferring crypto back into fiat. Stablecoins gave a straightforward answer to these two problems. Today, you may simply enter and exit the crypto volatility by utilizing stablecoins such as BUSD or USDC. How do stablecoins function? A pegging mechanism is required to create a currency that monitors the price or value of another commodity. There are many approaches, the majority of which depend on another asset functioning as collateral. Some ways have shown to be more effective than others, but there is no such thing as a sure thing. Stablecoins guaranteed by fiat. A fiat-backed stablecoin holds a fiat currency in reserve, such as USD or GBP. Each BUSD, for example, is backed by a genuine US dollar kept as collateral. Users may then change fiat to stablecoin and vice versa at the fixed rate. If the token's price deviates from the underlying fiat, arbitrageurs will soon bring it back to the set rate. Assume the BUSD is trading over $1. Arbitrageurs convert US money into BUSD and sell them at a higher price on the market. This raises the quantity of BUSD for sale and brings the price back down to $1. When the BUSD falls below $1, traders buy it and convert it to USD. This raises demand for the BUSD, causing its price to return to 1. Stablecoins backed by cryptocurrency. Crypto-backed stablecoins function in the same manner as fiat-backed stablecoins do. Instead of utilizing dollars or other currencies as reserves, cryptocurrencies are used as collateral. Because the crypto market is so unpredictable, crypto-backed stablecoins often over-collateralize their deposits as a hedge against price volatility. Smart contracts are used to control the minting and burning of crypto-backed stablecoins. Users may independently audit the contracts, making the process more credible. However, some crypto-backed stablecoins are managed via decentralized autonomous organizations, DAOs, in which the community may vote on project improvements. In this instance, you must either intervene or trust the DAO to make the best judgments. Consider the following example. To mint $100 of a DAI tied to USD, you must give $150 in crypto at a 1.5x leverage. You may utilize your DAI whichever you choose after you obtain it. You may move it, invest it, or just keep it. If you want your collateral back, you must repay the 100 DAI. Your collateral will be liquidated if it falls below a particular collateral percentage or the loan's value. When the stablecoin falls below $1, incentives are introduced to encourage holders to surrender their stablecoin in exchange for the collateral. This reduces the coin's supply, forcing the price to return to $1. When it is more than $1, users are encouraged to generate the token, increasing its supply and reducing its price. DAI is one example, but all crypto-backed stablecoins incentivize price stability using a combination of game theory and on-chain algorithms. Stablecoins based on algorithms. By eliminating the requirement for reserves, algorithmic stablecoins adopt a different approach. Instead, algorithms and smart contracts control the quantity of issued tokens. This concept is significantly more uncommon than crypto or fiat-backed stablecoins, and it is more difficult to implement properly. An algorithmic stablecoin system, in essence, will lower the token supply if the price falls below the fiat currency it follows. This might be accomplished by locked staking, burning, or buybacks. If the price exceeds the value of the fiat currency, fresh tokens are issued to diminish the stablecoin's value. What are the benefits of stablecoins? Stablecoins are adaptable and useful tools for cryptocurrency investors, traders, and consumers. Their key advantages include the following. 1. Stablecoins may be used for daily transactions. Shops, enterprises, and people value consistency. Because of their significant volatility, cryptocurrencies have yet to be widely used for payment processing. Large stablecoins have a history of holding their value, making them appropriate for everyday usage. 2. Stablecoins benefit from being blockchain-based. You may transfer a stablecoin to anybody in the world who has a suitable crypto wallet, which can be created for free in seconds. Double spending and fraudulent transactions are likewise almost impossible. Stablecoins are very adaptable due to these and other characteristics. 3. Traders and investors may utilize stablecoins to hedge their portfolios. Allocating a portion of a portfolio to stablecoins is an efficient strategy to lower total risk. Your overall portfolio will be more resilient to market price changes, and you will have cash on hand in case a good opportunity arises. During a market slump, you may also sell crypto for stablecoins and buy them at a cheaper price, i.e., shorting. Stablecoins enable you to easily join and exit positions without having to move money off-chain. What are the drawbacks of stablecoins? Stablecoins, while they're promised to facilitate mainstream cryptocurrency adoption, have limitations. 1. Stablecoins are not guaranteed to hold their value. While some huge projects have a strong track record, there have also been numerous failures. When a stablecoin struggles to keep its peg, its value might plummet substantially. 2. Absence of transparency. Not all stablecoins conduct comprehensive public audits, and many merely give periodic attestations. Private accountants do this on behalf of stablecoin issuers. 3. Stablecoins with fiat collateral are often more centralized than other cryptocurrencies. The collateral is held by a central institution, which may be subject to external financial control. This effectively gives them complete control over the currency. You must also believe that the issuer has the reserves claimed. 4. To operate, both crypto-collateralized and uncollateralized currencies depend largely on their community. Open governance systems are widespread in crypto projects, which means that users have a role in the creation and operation of each project. As a result, you must participate or trust the developers and community to operate the project appropriately. Examples of stablecoin applications. Let's take a closer look at two prominent stablecoins on the market, BUSD and DAI. Binance USD is a fiat-backed stablecoin, BUSD. BUSD is a USD-backed stablecoin produced by Paxos with Binance branding support. The New York State Department of Financial Services has authorized it, and periodical attestations demonstrate that fiat reserves match the issuance of BUSD. You may immediately mint fresh BUSD or burn BUSD for the underlying collateral using Paxos' website. This system allows for arbitrage, which helps to maintain the USD successfully fixed. MakerDAO is a cryptocurrency-backed stablecoin, DAI. DAI is a cryptocurrency-backed stablecoin that follows the US dollar on Ethereum. The MakerDAO community, which owns the governance token MKR, manages the currency. You may use MKR to develop and vote on project modification ideas. To cope with the volatility of crypto, DAI is over-collateralized, and users sign into collateralized debt positions, CDPs, that manage their collateral. The whole procedure is managed by smart contracts. Are stablecoins governed? Stablecoins have piqued the curiosity of authorities all over the globe because to their unusual combination of fiat and crypto. They are beneficial for purposes other than speculating since they are meant to maintain a constant price. They may also be easily and inexpensively transported worldwide. Some governments are even considering developing their own stablecoins. Because a stablecoin is a sort of cryptocurrency, it will most likely be subject to the same restrictions as cryptocurrency in your area. The issuance of stablecoins with fiat reserves may potentially need regulatory permission. Final thoughts. Nowadays, it's difficult to find an investor or trader who hasn't owned a stablecoin at some time. Stablecoins are often stored on crypto exchanges in order for traders to immediately capitalize on fresh market possibilities. As previously said, they are also quite beneficial for entering and exiting positions without having to pay out in fiat. Aside from trading and investing, stablecoins may be used to make payments, make international transfers, or generate passive income via staking in the DeFi network. Even while they are a fundamental aspect of crypto and have allowed the establishment of a new financial system, the hazards should not be underestimated. We've seen stablecoin initiatives with faulty pegs, insufficient reserves, and legal issues. While stablecoins are very adaptable tools, keep in mind that they are still a cryptocurrency with identical hazards. You may reduce risks by diversifying your portfolio, but do your own research before investing or trading, and never invest more than you can afford to lose. Thank you for watching.